Okay, I guess we are now live for our May the 2nd webinar. And today we're going to focus on the business owner. And boy, a lot of changes with the recent federal budget that's going to make people, if you're a business owner, boy, you really need to review what you're doing now, because what might have made sense before may not make as much sense moving forward. And it really emphasized the need for really solid planning. Uh, our topic really is, I put in the invitation, plan your business exit strategy and retirement plan now, or pay more tax later. And I think that's a rather accurate title, because I've met over 3 decades in this business. I've met a lot of business owners, and of course, they're focused on their business all the time, which is natural. Um, and they miss a lot of this. So, by the way, introducing myself, my name is Paul Barreca, certified financial planner at West End Wealth Planning, IPC Securities, IPC Securities Corporation. And today I'm very pleased to have my special guest, Vivek Bansal. Now, Vivek is Director of Tax and Estate Planning at Mackenzie Investments. Vivek holds the Chartered Professional Accountant and Chartered Accountant designations, as well as the Trust and Estate Practitioner designations, the TEP. Today's presentation will be available for replay for a limited time period. All those registered will receive an email in the next few days that will include a link to the replay of the entire presentation. You're welcome to send this link on to other people who might be interested. If you have other colleagues, friends, family member who are in business, boy, this would be a great resource to send on to them. We'll try to leave some space, some time at the end for question and answer. And what are we going to talk about today? Well, I'm going to look, and by the way, excuse me, I'm looking over at the slide deck over here. If my eyeballs aren't looking right into the camera, I want to follow the presentation that Vivek's got prepared for us today. It's a great one, by the way. We wanted to go through the difference between active and passive income through the corporation. Still some confusion there, I think. Just drawing it out, what's the most tax efficient way? What are the pros and cons? How to use your corporation to build wealth? What strategies are available to extract that money from your corporation on the most tax efficient basis? I want to talk about passive income and your impact on the small business tax deduction. That's, again, over the last number of years with the changes in 2018 and the changes today. Boy, planning in this area is now critical unless you want to pay way more taxes than you probably need. And building wealth effectively. By the way, this whole presentation today is going to be sprinkled with discussions of the recent proposed change to increase the capital gains inclusion rate, and of course, for a business owner to 66.7%. And the business owner starts at $1. For all those listening, if for an individual, you still get $250,000 a year, that's at 50% inclusion. Then over and above that, it's 66.7. But for the business owner, no break, right? 66.7%. That has a big impact on what we're going on. So, hello, Vivek.
Hi, Paul.
So we're going to start today. Why don't we get going? And the first thing we want to talk about was looking at active business income versus passive, and you're going to go through some slides on that for us. So I'm going to hand it over to you.
Perfect, thank you. So I'm just trying to share my screen here. So Will, can you allow me access? It's saying it's been disabled.
Oh no. Technical difficulties, but we'll figure it out.
Okay, there we go.
We got it? Fantastic.
Yep. So I can share my screen now.
Great.
Okay, awesome. So just before I get started, just briefly want to mention our disclaimer. So essentially what this disclaimer says is this presentation is not designed to provide tax or legal advice. The purpose of this presentation, as Paul mentioned, is to go through how the taxation works in a corporation, so you could have a knowledgeable discussion with Paul and your tax and legal advisors. So Paul already talked about the topics. I'll skip this, and I'll start with this integration slide. So when talking about how income is taxed in a corporation, it is really important to have a basic understanding of how integration works and what is this theory of integration. So the Canadian tax system is designed in such a manner that the government aims to equalize the tax that you would pay as an individual versus the tax you would pay by earning income through a corporation. So for example, if you're earning business income as a sole proprietor, the taxes you would pay under your sole proprietorship, where all income gets included in your personal tax return, those taxes, in theory, under this concept of integration, would equal the taxes you pay for earning that business income through a corporation. So in that case, if you're earning income through a corporation, there would be corporate taxes initially when that income is earned, and then eventually when that income is distributed out to you as a shareholder, there would be a personal level of tax. So the theory of integration says the taxes in both situations or both options would be equal. But of course, integration is never perfect in most situations. So what we see is there's usually a small tax cost of earning income through a corporation as opposed to earning it directly as an individual.
So
But there are many other.
just to clarify that, Vivek. So let's say you have $1 profit and you bring $1 out and you pay yourself a salary and you pay tax versus if you keep that money in the corporation and pay yourself a dividend, it's slightly more tax to run it through the corporation. Is that correct?
Correct. Yeah. So if I
Okay.
was to use Ontario as an example, let's say you're in a top tax bracket. If you're earning $1 of business income in that bracket, now you're paying taxes at 53.5% tax rate personally. Now, if you earn that same dollar of income through a corporation, you'd be paying corporate tax plus personal tax when that income comes out to you as a shareholder. So that averages out to 54.1% roughly. So
Yeah.
there's a 0.6% tax cost of earning that income through a corporation. But there's other factors to look at
Yeah.
as well.
Yeah.
There's deferral opportunities, which we'll get into in this presentation.
Okay, great.
So talking about how income is taxed, it's important to distinguish what type of income you're earning inside the corporation, whether it's active business income or passive income. So active business income is generally defined as income that is generated through the operations of the corporation. So whether it's providing services, manufacturing goods and selling goods, etc. Passive income, on the other hand, would be income that is not related to business operations. So it's typically generated from the investments within the corporation. So this passive income typically consists of income such as interest, dividends, capital gains, rental income, etc. So both active business income and passive income would be taxed at the corporate level and then again at the personal level when it's distributed out to you as a shareholder. But the taxation is very different among these two types of income. And that's what we'll get into throughout the remainder of this presentation.
Now, when you say capital gains, you're referring to realized capital gains. If the capital gains is not realized, there's still no tax on it. It's
Correct.
deferred.
Correct.
The government's always going to get their slice. They just have to wait a little longer.
Correct. Yeah. And that's where the tax benefit used to lie in earning that deferred capital gains through a corporation. But with the increased inclusion rate that you mentioned, eventually when that capital gain is triggered, that would typically result in a larger tax liability compared to what individuals would pay on that same capital gains.
Yeah.
But we could talk about that again in
Yeah,
greater
well,
detail.
just let people know one of the things that's often confused is, and we'll talk about later in the presentation, is, where's the best place to put my money from tax efficiency? And the kind of default has been have a passive corporate investment account. People have kind of put the RSPs or individual pension plans off to the side. I think most people aren't aware of the tax implications at the end of the day after tax. What's in your pocket? And it depends. So we'll talk about that later in the presentation.
Yeah, so if we talk a little bit more about active business income and how that's taxed inside a corporation. So under the Canadian tax rules, if you're operating a private corporation, it would typically be a Canadian controlled private corporation, or CCPC is the acronym that you may have heard in the past. So when you're earning active business income through your CCPC, so your private corporation, CCPCs have access to something called a small business limit, also referred to as a small business deduction, which is up to $500,000. So that $500,000 is shared among all corporations that you may own. So what this allows your CCPC to access is a small business tax rate on the first $500,000 of active business income. And that tax rate could range from 9% to 12.2%, depending on your province. In Ontario, specifically, it's 12.2% using 2024 rates. So what that means is the first $500,000 of active business income that you earn through your CCPC would be taxed at a low small business tax rate of 12.2%.
Yeah,
So if
we
you
should
compare
just,
that,
so we should just, oh boy, I had a thought in mind. I'm sorry. I should just mention that for question and answer, those who have a question, go down to the Q&A on the bottom tab. Do not go to the chat area, please. Go to the Q&A, and we will do our best to deal with them at the end of the presentation, but don't hesitate to put down your Q&A there now, okay?
So with active business income, so you have access to this 12.2 small business tax rate on the first $500,000. So it's important to note that $500,000 is shared among all of your associated corporations. So you cannot simply open up multiple corporations to multiply access to this small business limit because it will be shared among all corporations you own. But if you compare that, the small business tax rate of 12.2% in Ontario with the personal tax that you may pay if you were to earn that $500,000 directly as an individual, so as a sole proprietor in Ontario, if you're earning that level of income, you would be in top tax bracket, which again is 53.5%. But on average, because you have access to graduated tax brackets, on average, you would end up paying almost 45% in taxes on this $500,000 that you earn directly, assuming you have no other sources of income. So compared to 12.2%, there's a significant deferral, tax deferral benefit for earning active business income through a CCPC because you're not paying that personal tax right away. You're only paying the low small business tax rate initially. So you're able to accumulate retained earnings within your corporation for your benefit later on in retirement. So that's the tax deferral benefit. But you have to keep in mind the tax cost that I mentioned earlier is when you're looking at the combined corporate plus personal tax rate, which again in Ontario is 54.1% compared to the top personal tax rate at 53.5%. So there's a small cost when you factor in all the taxes you would pay. So initially within the corporation, and then when it's distributed out to you as a dividend, there will be another layer of tax. So that's important to keep in mind as well as a big picture.
I think it's worthwhile just to clarify for everyone the difference between active business income that's eligible for the small business deduction. Active business income is you own a widget manufacturing company and you make money selling widgets. Well, that's active business income. Passive income, on the other hand, is you put money that you earn in the corporation, often into a holdco, and set up an investment account, and you earn, as Vivek says, interest, dividends, capital gains, whatever. That's passive income. It's treated differently. Just to clarify that for everyone out there.
So this slide here shows the small business tax rates and the top personal tax rates across Canada using 2024 rates under the current rules. So in Ontario, as I mentioned earlier, the small business tax rate is 12.2% compared to the top tax bracket personally, which is 53.5%. So there's a tax deferral benefit of roughly 41% that you could defer in taxes by earning active business income through your corporation and retaining the profits within the corporation. So some key takeaways regarding active business income before we get into how passive income is taxed in your corporation. So for active business income, it is taxed at low rates because of the small business limit that your CCPC would have access to. So that creates the opportunity for a significant tax deferral within your corporation, meaning you're deferring the personal tax on that income until you're distributing out to yourself as an individual. So that allows for rapid accumulation of wealth inside your corporation. But as you accumulate that wealth, and if you're investing that retained earnings, that will earn investment income. So that's where we would get into the next section of this presentation, talking about how that investment income would be taxed in your private corporation. So the tax deferral that I talked about earlier, as it relates to active business income, the same tax deferral is unfortunately not available when you're earning investment income in your corporation. So because the government doesn't want to encourage individuals to defer taxes simply by setting up a corporation to earn passive income. So they have special rules in place along the lines of the concept of integration, which essentially state that investment income, for each dollar of investment income that you're earning in your corporation, as Paul mentioned, it would be subject to a high corporate tax rate. But a
And
portion of,
that's from $1 too, isn't it, Vivek? There's no
yeah,
graduated tax rate for passive income earned in a company. A lot of people aren't clear on that. Then the rate is 50.17%. Is that correct?
correct. In Ontario, it's 50.17% on most types of passive income. Mm-hmm. Yeah, so that applies to each dollar of income starting from the first dollar, so you don't have graduated taxation within a corporation. And so the government also applies this concept of integration to this investment income that is taxed inside the corporation. So they do allow a portion of that initial high tax that you pay. Portion of that can be refunded to your corporation when you're issuing taxable dividends to yourself as a shareholder. So the government realizes now you're paying personal taxes, so they refund you a portion of the high taxes you paid initially. And we'll talk about some of those details on future slides. So overall, however, when you're looking at earning investment income in a corporation, there is now a tax cost of earning investment income through a corporation because of the high corporate tax rate that you pay initially. And then layer on top of that, the personal taxes you would end up paying. The total tax that you end up paying through a corporation would be slightly above what you would end up paying if you were to earn that income directly as an individual. So two key differences in how investment income is taxed as compared to active business income. Investment income would not be eligible for the small business deduction I talked about earlier. So the $500,000 of that allows corporations to access the small business tax rate does not apply to investment income. So investment income is taxed at much higher corporate tax rates. So again, it's 50.17% generally in Ontario. There's a
No,
portion that
that's different, of course, if that's for interest, net rental income, but there is still some benefit from uh, dividends, eligible dividends, and realized gains less than that, correct?
correct, yeah. So
Uh,
eligible dividends would be subject to something called a Part 4 tax, which we'll get into, which is a special type of tax. And capital gains, only a portion of the total capital gains realized would be taxable. So currently it's 50% of capital gains being taxed at the same 50.17% tax rate. But if the proposals that Paul mentioned earlier, if those proposals are passed, a larger portion, so roughly 67% of those realized capital gains would be taxable at that same 50.17% tax rate initially.
By the way, just for those people who have joined us recently, we're talking about business owners. We're talking about taxation, withdrawing money tax efficiently, taxation of dividend income within passive investments, and so forth. And of course, we're going to be talking about the proposed capital gains inclusion rate hike to 66.7%. By the way, before the presentation, I asked Vivek, I said, look at, you're probably closer to this than I am. Is there any chance that this might not go through? Sometimes government changes. And he said, it looks like not. He says, it looks like this is going to go through. Maybe they'll make some modifications on it, but it looks like not. And by the way, again, also, if you have questions, please go to the Q&A tab at the bottom of the screen. Put them in there. We're going to try to get to your questions at the end of the presentation. So there's nothing wrong with, if Vivek says something and you go, oh, got a question there, write it down. We'll try our best to get to it. And if we can't get to it, we'll try and get back to you afterward to answer your questions. Okay. Vivek, back to you.
Perfect, thank you. So if we talk a little bit about how this refundable tax mechanism works, that's part of this integration concept I mentioned earlier. So initially, each dollar of passive income or investment income you're earning in your corporation would be taxed at a high rate. A portion of those taxes that you pay would be added to this notional account, which is referred to as the refundable dividend tax on hand account. I'm just going to call it the refundable account for short. So a portion of the taxes you pay initially gets added to this notional refundable account, and you're able to receive refunds based on the balance in this account from CRA when you're issuing taxable dividends to you as or to any of the shareholders of your private corporation. So the way the math works is roughly for every $3 in taxable dividends that are paid out to shareholders, you would get up to $1 of refundable tax back from CRA. So this is taxes that you paid previously, but now it's sitting in a notional refundable account, which can be refunded back to your corporation.
Now, this really emphasizes the need for planning. I know this stuff like you do, Vivek, but it's not uncomplicated. And for the layman listener, you could see where they're looking at that and go, oh, geez, my head is exploding with all this information. It really emphasizes the need to sit down with your tax and experienced advisor to understand this, to understand what's the best strategy for you and your business. And by the way, again, we'll have question and answer at the end and an opportunity. If you have other questions, there'll be an opportunity for you to ask them to us at a later date.
For sure. And so the last bullet on this slide is what Paul briefly mentioned earlier. So dividends that your corporation receives from other Canadian public corporations would be taxed at a special rate of 38.3%. So that's referred to as Part 4 tax. And 100% of this tax is refundable because the government realizes that the dividends your private corporation is receiving from other Canadian public corporations is from after-tax dollars. So the public corporations that are paying dividends, first they pay tax on all the income that they earn, and they're paying dividends using after-tax dollars. So government realizes that the dividends your private corporation is receiving is using based on after-tax dollars, so they don't apply another layer of corporate tax on that same dividend. But to discourage deferral of personal taxes, they do apply this refundable tax mechanism, so the special Part 4 tax that would initially apply but can be 100% refunded to your corporation when it issues the eligible dividend to shareholders. So essentially, there would be no additional tax at the corporate level, although initially the corporation pays a portion of tax, but that gets 100% refunded to the corporation when dividends flow out to the shareholder in this situation. So the tax rules get slightly more complex when we're talking about refundable accounts, the notional refundable accounts. Previously, there only used to be one notional refundable account to track, but that created some arbitrage opportunities. Corporations were able to issue eligible dividends to receive refunds of taxes they paid on non-eligible income. So to resolve that, government now has required corporations to track two notional refundable tax accounts. So one is called non-eligible refundable dividend tax on hand account. The second is the eligible refundable dividend tax on hand account. So I won't go through the details of what gets added to each of these accounts. That's something Paul and your tax accountant can help you with in understanding in greater detail based on your specific situation. But one key point to remember is if you have a balance in your non-eligible refundable dividend tax account, that can only be recovered from CRA when you're issuing non-eligible dividend from your corporation. Previously, you could issue an eligible dividend, which have lower tax rates to receive a refund, but now the government is requiring you to issue a non-eligible dividend, so pay slightly higher taxes to receive a refund from this non-eligible refundable account.
Now,
For eligible,
just to clarify for our audience, so what, Vivek, you're saying is to get this refundable tax, you have to take the money out of the corporation as a dividend income.
correct.
And then you'll get this, as Vivek mentioned, about $1 back for every $3 of dividend. So again, that's when you take the money out. That's when you get the money back. So if you leave the money there for 5 or 10 or 20 years, you're not going to get that money back for 5 or 10 or 20 years.
And that's where planning becomes especially important because that money is sitting in that notional account with
Yeah.
CRA, but not earning anything for you or your
Nope.
corporation.
They
So
don't
you're
give you
losing
anything.
time value of money on that and
Yeah.
looking at inflation rates, so it could really deteriorate in terms of buying power. So that's important to keep in mind. So if you look at the high level categories, three main categories of investment income that your corporation can earn. So first being interest and foreign income. As I mentioned earlier, it would be subject to the high corporate tax rate initially, which in Ontario, again, is 50.17% on each dollar of interest and foreign income earned inside your corporation. A portion of that would be refundable. So in Ontario, that's roughly 31% that would be added to this notional refundable account. So it will be refundable back to your corporation when your corporation issues a taxable dividend to you as a shareholder.
Now, Vivek, just so we're clear, when you say foreign income, if you're referring to dividends paid by, say, a U.S. company you own, I don't know, whatever, U.S. company that pays you a dividend of 2%, that's not treated the same way as a dividend from a Canadian corporation, is it? There's no tax, there's no dividend tax credit. It's just taxed as interest income, correct?
Correct. Yeah. So
Yeah.
it doesn't have that special Part 4 tax treatment either. It's simply taxed at the 50.17% tax rate.
Yeah.
Yeah, just like interest income within a corporation. But if you're earning Canadian eligible dividends, so dividends from Canadian public corporations, those would have access to the special Part 4 tax I mentioned. So 38.3% gets paid initially, but 100% of that is refundable to the corporation when the eligible dividend flows out to the shareholders. So it gets taxed in the shareholders' hands. And the third main category is when your corporation is earning capital gains. So this would be realized capital gains from the sales of investments, for example, in your corporation. So currently, under the current rules, 50% of that capital gain would be taxable at the corporate tax rate of 50.17%, but the non-taxable portion gets added to this special capital dividend account. So that's another notional account for your accountant to keep track of when filing tax returns, is this capital dividend account, which could be used to distribute tax-free capital dividends to you as a shareholder. So again, under the current rules, 50% of capital gains that are not taxable gets added to this capital dividend account, but that would change if the proposals get passed going forward. If 2/3 of capital gains become taxable inside the corporation, only a third would get added to the capital dividend account balance. So if we talk about the capital dividend account a little bit more, so as I mentioned, if you have a balance in the CDA account, you could designate dividends as tax-free capital dividends, so you would receive cash flow from your corporation without paying any tax on that income. So there's three main components of the CDA balance. So the first is non-taxable portion of realized capital gains. Again, currently it's at 50%, but that would reduce to a third once the proposals that were introduced with the 2024 federal budget do get passed. The second main component is tax-free life insurance proceeds that your corporation may receive. So if the corporation owns a life insurance policy on the life of any shareholder, as an example, and that shareholder passes, the corporation receives the death benefits. The amount of death benefits less the adjusted cost basis of the insurance policy would also get added to the capital dividend account, which can then be used to distribute tax-free capital dividends to the shareholders or to the estate of the shareholder that passed away, as an example.
Yeah, just to spend a bit of time on tax-free life insurance, this now has the ability, you can fund specifically designed life insurance where it can accumulate significant amount of caps within the holding company, passive income, and there's no tax implications whatsoever. It does not reflect on the $50,000 limit where you start to lose your small business deduction. And it can be through a leverage program, allow you to get that money out of the corporation on an almost tax-free basis down the road. This is something we're going to do another presentation on just itself. With the new capital gains higher inclusion rate, this becomes a better, or it becomes more advantageous than it did before. Again, it's not for everyone, And this is again where you really need to do your planning, understanding the pros and the cons. But for the right person, this can be a tremendous type of strategy to use when you have a corporation and significant passive income.
Mhm, mhm. Yeah, so the only other point I want to mention on this slide regarding capital dividend account component would be the 100% of the capital gains when a security is donated in
Yeah.
kind. So if you're making in-kind donations through your corporation, that means your corporation would then benefit from zero capital gains inclusion rate on any appreciation in that donated property. So if he has, say, $100,000 of capital gains at the time you donate that property, your corporation would not pay tax on any of those capital gains because the property is being donated and the $100,000 of capital gains get added to this CDA account, which could then be used in the future to distribute tax-free capital dividends
Vivek,
from
can
your
I,
corporation.
can I ask you a question about that? Is that the same where if you donate something in kind personally, do you still get the full tax benefit of not paying on the unrealized gain? Is that still the same personally?
Yes, that is
Because
still the same.
don't you find that's underutilized? I mean, I give to charity every year, and I've started handing over stock because,
Mm,
well, geez, I've earned. Why should I? I end up saving more money.
mhm,
It's win-win, and I think a lot of people aren't aware of that. Even for a couple $1,000, donate some stock that has an unrealized gain. You don't have to pay tax on that unrealized gain forever.
mhm. Yeah,
That's not a
yeah,
bad deal.
yeah. It's definitely a good strategy to consider. Mhm.
But do you find that's underutilized based on your experience?
Yeah, a lot of people are not simply not aware of that
Yeah.
strategy, so they're not taking full advantage of it. But you have to also keep in mind that uh, so donating small amounts should be fine, but if you're making large donations, alternative minimum tax can also come
Yeah.
into
Yeah.
play for individuals, but that doesn't apply to corporations. So that's another benefit if you want to donate in kind through your corporation. Corporations are not subject to alternative minimum taxes.
Okay.
So this slide just summarizes the combined corporate plus personal tax rate you would pay in each province for those three main types of passive income earned through your corporation. So if you look at Ontario, what you see here is for interest income, the combined corporate plus personal tax rate would be 57.9%. So if you're comparing that to earning interest income directly as an individual and you're in the top tax bracket, you'd be paying 53.5% roughly. So there's a small tax cost in this case of roughly 4% of earning interest income through your corporation because the combined corporate plus personal tax rate ends up being higher than the personal tax rate you would pay otherwise.
Now, Vivek, does this take into account the refundable dividend tax on hand, or is this pre-RDOHD,
So this takes into account,
what you're going to get back
correct.
eventually?
Yeah,
Okay. All
yeah,
right.
yeah, all of that. For dividends, so this is looking at eligible dividends, 39.3%, which is the same as the taxes you would pay personally. Because remember, in a corporation, 100% of that taxes that the corporation pays is being refunded back. So there's no additional cost of earning it through a corporation. It's just a timing issue in terms of when you get the refund back. And for capital gains, at using 50% inclusion rate, which is the current tax rules, the combined corporate plus personal tax rate is 29%, compared to if we're in the top tax bracket personally, you'd be paying roughly 26.8% in taxes as an individual for realizing capital gains in the top bracket. So there's again roughly a 2% tax cost of earning active business income, or sorry, earning capital gains through a corporation.
Yeah. Just to refresh our viewers today, we are, for those people who joined in a little late, we're talking with Vivek Bansal, a tax and estate specialist with Mackenzie Investments. We're talking about using your corporation, passive income, what's good, what isn't good, what are the pros and cons on this. And as we get on to the presentation, we're going to talk about some more effective strategies to withdraw this money out a little bit more tax efficiently. We're also going to talk about what's better to do. Is it better to have that passive investment corporate account, or is it maybe to consider the RSP, the old reliable? What's better? And we'll find out Sometimes one is better, sometimes the other is better. Vivek, back to you.
Sounds good. Thank you. So the next topic is looking at the impact earning passive income within your corporation could have on your small business limit. So to discourage business owners from deferring personal taxes on the investment income that they're earning through a corporation, the government introduced these rules back in 2018, and they started applying for all tax years beginning in 2019. So what these rules state is essentially if your CCPC starts to earn passive income exceeding $50,000 in a given year, so for each dollar that it exceeds that threshold, your small business limit would be reduced by $5. So what does that mean? So let's use a simple example. Let's say your corporation earns $100,000 in passive income, and these rules would apply. So that's $50,000 above the $50,000 threshold. So that would mean that the small business limit would be reduced by $250,000 for that applicable year. So that means your CCPC, even if you're earning active business income, you can only access the small business tax rates on the first $250,000 of active business income instead of the full $500,000 that I talked about earlier. So that's important. Another important consideration to keep in mind when your corporation starts to earn significant passive income each year, which exceeds $50,000 threshold in any given year.
And it really, again, emphasizes the need for planning here and really planning when to trigger your passive income in the corporation. You know, there is some flexibility there. You want to speak with your advisor on this. What's the most tax efficient way to avoid eroding that small business tax deduction? By the way, just to mention also, again, the Q&A, if you have questions, we got a number of questions we'll try to get to at the end. Those questions we cannot get to, we will get back to after the presentation to discuss with you. Or if you want to talk with us about, hey, Paul, I'm not quite sure I'm in the right things, you can send me an email at info@westendwealth.com, info@westendwealth.com. Vivek?
Yeah, so the only other point I want to mention in regards to the small business limit reduction rules is that the good news is for businesses in Ontario, this rule does not apply at a provincial level. So that means if your CCPC, if your private corporation is earning significant passive investment income, the erosion of the small business limit would only impact the federal tax rate and not the provincial tax rate. So essentially what that boils down to is if you lose all of your small business reduction in Ontario because your corporation is earning excessive passive income, the tax impact, the additional tax cost would be $30,000 in Ontario because only the federal tax rate would increase from 9% to 15%, but the provincial tax rate would stay the same. So additional 6% of taxes on $500,000 of active business income would be additional $30,000 of taxes that your corporation would end up paying if the full small business limit is eroded away because of significant passive income inside your private corporation. So that'd be a key consideration to keep in mind regarding the decision of what type of income you're earning in your corporation. So overall, just to wrap up this investment income portion of this presentation, so some key takeaways regarding investment income is subject to high corporate tax rates, which again in Ontario is generally 50.17%, unless you're earning Canadian eligible dividends that have special Part 4 taxes. So it is important for you to talk to Paul and talk to your tax advisor about what is the most tax efficient way of earning investment income in your corporation, because ideally you may want to focus on investments that reduce taxable distributions and focus on capital appreciation each year. So you're not triggering passive income inside your corporation each year and paying taxes at these high tax rates. And it can also help you protect your small business limit because as we just talked about, if your passive income starts to exceed $50,000, that can impact the small business limit that your corporation would have access to benefit from those small business tax rates. So the next I want to talk about is using Series T funds. So a lot of individuals consider using Series T funds to help them minimize taxes in a corporation. But just want to explain there are some misconceptions about using these funds in a corporation. So if you're not familiar,
Vivek, just to clarify,
Mm.
T funds are essentially mutual funds held in a corporation that try to minimize distributions on an annual basis. So again, if you have that in a corporation, minimizing distributions is going to minimize that big tax hit that you get within the corporation, just to clarify ahead of time.
Yeah. So yeah, and just to add to that, so how these funds work is the the goal of these funds is to provide you cash flow primarily in the form of return of capital,
Yeah.
as opposed to taxable income. So you still get cash flow to help pay for expenses, as an example. Especially these could be really beneficial in retirement, but you're not increasing your net income or your taxable income in the year, so you're not getting pushed into a higher tax bracket. But when you're using these funds inside a corporation,
Mhm.
even though your corporation receives that return of capital each year through these funds, it's important to keep in mind that the return of capital is for the corporation, but it would not translate into being able to flow that out as
Yeah.
return of capital to you as an individual. It's because that investment is typically bought using retained earnings within the corporation. So even though the corporation does not pay any tax on that return of capital, when that money is distributed out to you as a shareholder, it would likely still be taxed as a taxable dividend. That's
So, so,
important to
so,
keep in mind.
so the benefit there is again reducing tax potentially within the corporation and potentially reducing that small business deduction erosion. But you take the money out, you still got to pay the piper. It's
Mhm.
amazing how government always, at the end of the day, you always got to pay the piper with the government. I don't know.
They catch all
They
the
they
different
they
ways.
don't want to give anything to you.
Yeah. So if you talk about some other strategies for extracting corporate funds tax efficiently, so the traditional way of extracting corporate funds is using either paying yourself a salary or paying yourself a dividend. But there are other tax efficient ways that may be available for based on your circumstances as well. So one of those strategies is to consider paying a tax-free capital dividend, which as we talked about earlier, if your corporation has a balance in the capital dividend account, that balance can be used to designate dividends as tax-free capital dividends, so they won't be taxed in your hands when you receive that money from your corporation. Another strategy is if you ever made a loan to your corporation. Sometimes business owners would make a loan initially when you just incorporated your business, because the corporation doesn't have enough funds to pay for the expenses. So sometimes business owners would loan the money. So that shareholder loan can be repaid back to you on a tax-free basis. That's something a lot of individuals forget to think about. So that's important strategy to keep in mind. Another strategy is when you invested or when you purchased or subscribed for shares in your own corporation, the amount of after-tax dollars that you use can be returned to you as tax-free money. So for example, let's say you subscribed for shares initially for $10,000 or whatever the amount may be, that $10,000 can be returned to you as tax-free money. So that's referred to as paid up capital in your corporation. A couple of other points that I want to highlight is if your corporation, you've implemented an estate freeze at some point, and if you're not familiar with an estate freeze, it's essentially an estate planning strategy that allows you to freeze the interest in the value of your shares in your corporation at a given point in time, and it allows you to issue new common shares or new growth shares to family members or to the next generation that is interested in taking over the business. So now they start accruing the future growth in the business in the shares they own, and that growth wouldn't accrue to your frozen shares. So if you have frozen shares in your private corporation, one strategy for you to keep in mind is you could consider redeeming those shares in your retirement. So that would allow you to receive tax efficient income from your corporation in the form of taxable dividends if your corporation has CDA balance that dividend can be designated as a capital dividend if it has, and part of those dividends may also be able to be paid out as eligible dividends to reduce your taxes. But the added benefit of redeeming your shares over time is eventually when an individual passes away, the shares that they own would be subject to capital gains taxes. So that if it's a large capital gain that's been accrued in those shares, that could result in a large tax liability. So that tax liability can essentially be spread out over your retirement over a number of years at lower tax brackets by redeeming these shares in your retirement. And the last point I want to mention is when paying out salary or bonus or dividends from your corporation, two key points to keep in mind is make sure that the salary that you're paying to yourself or to another family member is considered reasonable and it's for identifiable services that you're providing to your corporation. So if, let's say, if the family member is not really involved in the corporation and you're still paying them a salary, that can result in double taxation because it would likely be considered unreasonable. So the corporation would not get a tax deduction, but it would still be taxed in the family member's hands. And with dividends, important to keep in mind that the rules also changed back in 2018, where previously you could pay any amount of dividends to family members without worrying about any tax rules that would prevent you from paying dividends. But now, as of 2018, where non-active family members are receiving dividends from your corporations, they could be subject to special tax rules, which essentially could apply the top tax brackets, top tax rates on those dividends. So the government has essentially taken away that flexibility in paying dividends to non-active family members as a form of income splitting. So you have to be careful in that situation as well.
I just wanted to apologize to our listeners. You could probably hear in the background noise here. Of course, we're working from our home offices, and I believe one of my neighbors is putting in a pool, so there's dump trucks in the background. I apologize for that. We haven't that much time. I want to spend some time now, Vivek. We talked previously about what's the best place from a tax efficiency point of view in terms of putting money into the corporate account, or should we invest in RSP? A lot of business owners, a lot of individuals, I found they just discount the RSP, or for a business owner, the other option is the individual pension plan, which is a great option for specific business owners. And a lot of people just discount them and they say, well, you have to pay tax eventually, so I don't want to do that. But what's the most important thing is if you compare that original dollar of profit from the company and you invest it, at the end of the day, what after-tax dollar, how much after-tax dollars do you have in your pocket, in your jeans? If you compare a passive investment account versus an RSP or an individual pension plan. And in the past, in a great majority of circumstances, and a lot of people don't realize this, you're actually better off with an RSP. You had more money in your pocket after tax, not all the time. And it really depended, right, Vivek, on what was the constitution or the constitution, what type of investments did you have in that corporate account? Did you have interest, right? If you had net rental income, dividends, substantially, you're really much better off with the RSP. Now, the only way in the past where you had after tax better is if in your corporate investment account, you own investments that grew on a completely tax deferred basis and generated only capital gains. Now, with these tax changes, that changes the equation a bit, doesn't it, Vivek?
Yes.
Let's talk about that for a couple of minutes. Again, we've got about 11 minutes left. I want to leave a little bit of time for question and answer. Can you quickly just chat about that?
Sure. Yeah. So you raised some good points, Paul. So typically RSPs were seen as beneficial, especially in situations where you can extract that money from your corporation on a tax-free basis because that's a deduction in your corporation. So you're not paying any corporate taxes, and it grows tax sheltered within your RSP. And especially if you expect to be in a much lower tax bracket later on in life in your retirement, then you can start drawing on that income and pay really low tax rates on that income. So it could be very beneficial in that situation. And as you mentioned, corporations were preferred because they provide tax deferral opportunity that I talked about earlier, especially if you're earning active business income and you're only paying that initial small business tax rate for within your corporation. So you're deferring a large amount of taxes and you're really accumulating that wealth in your corporation. So that could be beneficial, but the ideal situation was let it grow tax deferred within the corporation. But now with the new proposals, uh, a greater portion of those capital gains would become taxable. So it would throw off that benefit, and it would really require a detailed analysis to see what are your expected returns to see which option may be better.
Yeah, now what that effectively does was make the after-tax benefits of the RSP or the individual pension plan more advantageous than it was before. And again, I think a lot of business owners just discount this without understanding the numbers, that they may, in a decent number of situations, they're better off in terms of the money in their genes at the end of the day after tax by using the registered plan or an individual pension plan. I also want to bring back something we chatted about briefly before, and that is the use of corporately owned insurance. Again, with these tax changes that are coming up likely, this is going to make this strategy more advantageous in terms of where you can have a significant amount of money grow within a tax sheltered permanent life insurance plan, no taxation in the corporation, and it can be structured to flow out retirement income on a virtual tax-free basis at the end of the day. Again, this is a strategy that requires expert opinion. And by the way, if you want to talk to us, if any of those listening who are interested to talk to that or any other strategy, just send me an email at info@westendwealth.com. We're happy to chat with you. And I think that's in the chat screen below the email address there. Just see if we get to a couple of questions here. We had one question here, Vivek, because only got a few minutes left. This is from a doctor who says, look, I have a professional corporation in dealing with dividends. Can I share with my children? And I don't think a doctor can, but you help me out here.
Yeah, so previously you could, prior to 2018, you could, but as I briefly mentioned on the last slide there, the government has these new tax on split income rules that essentially limit uh, being able to do that anymore. So if the family member is not really involved with the business, they haven't contributed capital into your corporation, they haven't really put in the hours to help you out with the business, then paying dividends to them could be subject to the top tax bracket. So essentially, there may not be any benefit of doing that form of income splitting if they're not active in the corporation.
Yeah. So we're getting up. Maybe time for one more question here, then we'll start to sum things up, summarize things. Again, we've had the pleasure of speaking with Vivek Bansal, a tax and estate specialist at Mackenzie Investments. We've been talking about using your corporation. What are some of the best ways, understanding the tax implications of various strategies within your corporation to take money out of the corporation on the most tax efficient basis. We've been talking about how to draw out most tax efficiently for retirement income, the relative advantage of an RSP or an IPP versus a corporate investment accounting. And these things they are not uncomplicated. Don't go and make these decisions on your own. Get great advice. If you'd like to speak to us, again, just send me an email at info@westendwealth.com. Excuse me. Geez, I got a number of questions here. Which one? I have just one question here. I have a personal RSP maxed out. Are you saying my company can have an RSP? No. Once your company cannot have an RSP, what we were talking about is, do you want to use a personal RSP or an individual pension plan, or both? You can add money into your corporate plan, but a company cannot have an RSP. However, a company can contribute directly to an individual pension plan. Again, there's some significant benefits there over an RSP, including some fantastic, if your kids are taking over your business, there's an incredible estate planning benefit with an individual pension plan, but that's for another program. So I think we want to start wrapping things up for today. First, I want to thank Vivek. It's fantastic. Next time, bring along some more statistics and more information, will you? I'm sure everyone's got everything memorized there. Fantastic. I really want to thank you. That's great information. I mean, I understand it. I've been doing this for over 30 years, but if someone's a layman, this boy, that's a lot of information. Again, keep an eye out for those listening in your inbox. If you want to review this, we're going to have a replay. If you want to send it on to other people who might value from it, you'll be able to pass it on to them. Again, if you have any questions, just send us at info@westendwealth.com, or if you want to really sit down and have a chat, that's the best way to do it. It's hard to do this stuff. It's way too complicated to start answering questions in an email. And by the way, make sure you join us for our weekly podcast with my associate, William Barreca. That's called Retirement Straight Talk with Paul and William. If you're not on our mailing list and you want to get that, hey, just send us an email and we'll be happy to add you to our mailing list. So again, by the way, if you have questions at the bottom there, we have a number. Just give me a note, let me know your email address, and we can set up a time to chat, and we can do our best to answer those questions. Unfortunately, Vivek had too much information today. We didn't have time. But again, thank you, Vivek. Fantastic. And we'll be looking at putting on more of these presentations in the future this year, and we'll go from there. Again, everyone, thank you for joining us. Thank you, Vivek. And I guess it's a good time to wrap things up right now. A couple of minutes early, but that's okay. It's a nice day outside.
Thank you.
Take care, everyone. Enjoy, and thanks for joining us.